Good morning and welcome to Getting Started with Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined by my good friend Michael Fairborn out there in the chat. Michael's 20 plus, 30 plus year veteran of the financial markets. We're getting older these days. He's there to help facilitate the conversation. So keep and be a part of that conversation by chatting in questions to Mike. He'll help to keep that flow of the conversation going. If you're watching this in a recorded version, leave us a comment in the comment section. We'll respond to that as quickly as we can. For those of you that are brand new to trading options, you are in the right place. For those of you that have been trading options for a while, this is also the right place because you may benefit from a quick review of option basics. You may you may also gain some nuances perhaps that you hadn't considered before. So hopefully we'll take you down that path as well. For those of you that have been to some of our live events like our technical analysis and option strategies live workshop, this is a great companion piece and a great companion webcast to that conversation in terms of reviewing the concepts and the ideas that we talked about in the morning on day 2 of that live event. For those of you that aren't familiar with our live events, I will show you what those look like here at the end of the discussion today. So stick around for that. A couple of quick reminders, though, housekeeping-wise, as we get started. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy or account type or individual symbol or anything else. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure you're aware of the characteristics and risks of standardized options. Make sure that you understand and have read that options disclosure document before considering any of those transactions. We're going to talk a little bit about technical analysis, a little bit about probability analysis in this discussion, some elements of fundamental analysis as well. All of those are theoretical in nature. None of those are guarantees. Schwab doesn't recommend, however, the use of technical analysis or really any other method as a sole means of investment research. Investing does involve risk, including the loss of principal. Same thing with options. When we talk a little bit about the continuation of this idea, remember that we can be long an option, meaning we buy it. We could be short an option, meaning we've sold it. Anytime that a trader is short an option, and it's an American-style option, there's the possibility that that obligation that's created could be assigned at any time, regardless of whether the option is in the money, out of the money, or at the money. We'll talk more about what those terms mean here in a little bit, but those are things you need to pay attention to. We're going to be using the Thinkorswim desktop software platform. Great learning environment, not a guarantee of future success, but it is a good sandbox in which to play and practice. Remember, though, that as you move your practice from paper trading to live trading, some things might be different. Paper money account does not facilitate that early assignment of short options, and it may fill orders at a different price than you might experience in a live trading platform. So just be aware of that. Also remember that stop orders, and we're not really going to talk about those in today's discussion, but stop orders can result in an order filling at a different price than expected, and a stop limit order can potentially result in an order not filling at all. So we're going to jump into some of these discussions along the way, but let me do this before we get started and before we jump over to the Thinkorswim desktop software platform. I wanted to kind of give you a real quick overview of how this getting started with options series and playlist works. So we'll start with lesson 1, and for the next 12 weeks, we'll go in sequence: long calls, long puts, covered calls, buy rights, short puts, short verticals, short call verticals, long call verticals, long put verticals, protective puts, and then things I wish I had known when I started. So that's the rotation, that's the cycle. A little bit like enduring Wagner's ring cycle, but maybe hopefully a little more profitable for you as a trader. That said, along the way, we will oftentimes incorporate one-off discussions into the mix. So you're going to see those in the playlist as well. But we're right here on lesson number 1, Introduction to Options. That's where we're going to focus today. So I notice in the conversations here that there are many of you who are saying, hey, I'm brand new to options. Glad to have you with us. Again, being brand new to this environment of trading options, we now kind of have to shift our mindset a little bit. And the mindset for trading options becomes a little bit different than for the mindset of buying a stock. So let's talk a little bit for just a moment about why traders and some traders may use options. And these are some of the means, but they generally fall into three buckets. The three buckets are to hedge risk, to protect against adverse movement, primarily in stocks that are already owned in a portfolio. And in fact, this is the reason that option contracts came about, was to hedge off risk for institutional investors. They gave them a mechanism in which they could monetize potentially that risk and take advantage of a protective instrument like a protective put. One of the other means that options traders use options for is generate income, meaning selling options to begin with, bringing in an option premium, using that as a means to grow a portfolio by buying more shares of stock, or utilizing that income from selling option premium, collecting that premium, using that for daily operations or living expenses or whatever they might use, might need that income for. So that's really the second means that options traders primarily employ options, is to generate income. The third method and the third reason perhaps that options traders might employ options is to speculate on directional price movement, meaning I see a stock, I think the price of that stock is going to go higher, or the price of that stock is going to go lower. I want to take advantage of that movement using something other than buying the stock, going long the stock, or going short the stock. And the intent for using options, because they are leveraged, is to be able to speculate on that directional price movement for a lower entry cost, meaning utilizing the leverage of that option contract. Now, the possibility is in a long option, whether it's a long call or a long put, there's the possibility of losing everything that was invested in that position. So those are the three buckets: hedging risk, generating income, speculating on price movement. And you'll, as we go along through this discussion, you'll hear me talk about those three buckets of uses for options contracts. Now, let's break options down into what they are, what an options contract is. For those of, again, for those of you who are brand new to trading options, this is the definitive starting point. For those of you that have been doing this for a while, again, this is going to be a review, but we'll kind of break this down in terms of the differences between a stock position and an option contract. A stock position, we ask the question, well, why do we buy shares of stock? We buy shares of stock because we want the price of the stock to appreciate. We gain a dollar for dollar increase in our value of that position if the price of the stock goes up. We also lose a dollar for dollar if the price of the stock goes down. But it gives us ownership of those shares. Those shares don't expire. However, they're going to cost whatever the current market price is. They may pay dividends, and remember that dividends aren't guaranteed. Dividends can and do change. And we're paying the full boat for the cost of the stock. Whatever the price of the share of the stock is, times the number of shares that we're buying, that's going to be the cost of our position. So we're not really paying what we would refer to as a premium over and above whatever that value is of that option, that stock share. Now, on an option contract, it's a little bit different. We don't have an ownership right, or an ownership interest. We have the right to become an owner or become the seller. So an option contract gives us the right to do something, but doesn't actually create that until we choose to exercise that right. Now, an option contract has a finite expiration date. It has a lifespan. It may cost less because it's a leveraged position. doesn't convey dividends, and it doesn't convey shareholder rights. And for that right to do something, when we buy an option contract, we are paying a premium to accomplish that. And we're also paying for that period of time that that option contract exists. So stock position and option contract, a little bit different from one another. The option contract derives its value from the price of and the movement of that underlying stock. So these are oftentimes referred to as derivative contracts. So what is that option contract? It's a two-sided contractual agreement between a buyer and a seller. The buyer of the option contract is long the option contract. Doesn't mean they're in it for a long period of time. Doesn't mean that if they're short, they're in it for a short period of time. But that word long and that word short in this context means the buyer of an option contract is long the contract. The seller of an option contract is short the option contract. So the buyer is the owner. The seller is the writer of that contract or the creator of that contract. The buyer of an option contract has the opportunity to buy or sell shares at a specific price. We call that price the strike price. The seller of that option contract has an obligation to fulfill on whatever that commitment is that's on the other side of that right. So if I have the right to buy the stock, somebody, the seller, has the obligation to sell it to me. If I have the right to sell the stock, somebody on the other side, the seller, has the obligation to buy the stock. So these are oppositional circumstances here. Now, if we're buying an option contract, we're paying a premium. If we are selling an option contract, we are collecting a premium. We're receiving that premium for the obligation. Now, you notice the words that are used here: rights versus obligations. A right gives us a choice. We can choose to exercise that right or not. An obligation, not so much of a choice. We have the obligation or the responsibility to meet the conditions of that obligation if we are assigned that responsibility to do so. So that's the difference between being the buyer of an option and being the seller of an option. Now, there are more nuances to this, but this is really kind of the straightforward basics of this discussion. Now, let's move on. What is an option contract? We keep talking about this idea of an option contract. Well, the contract, like any other legally binding agreement, has some specifics. It has some definitions. So the contract has a definition of what underlying symbol it refers to. So in this particular example, it's XYZ, which is now an actual stock, so we've got to change that. So we'll use ZYX as a hypothetical. So an option contract might represent a right or an obligation to buy or sell 100 shares of ZYX. One standard options contract represents 100 shares of the underlying stock. Now, there are option contracts on everything from individual stocks to exchange traded funds to indexes to futures, currencies. There are option contracts on a lot of different financial instruments. The ones that we're going to primarily focus on here are going to be equities, stocks, basically. Now, an option contract also specifies an expiration date in which that lifespan of the option contract is defined. The date the contract ceases to exist is referred to as the expiration date, and those dates are standardized by the options industry. And in fact, because options have become such a liquid product and such a retail-driven product, more and more frequent and available expiration dates are becoming listed to simply address the demand for options contracts. Now, that strike price that we talked a little bit about, that we mentioned, that is the price at which we define in the option contract the right or the obligation. So if we have the right to do something at a particular price, that particular price is called the strike price. So there might be, for any particular set of option contracts or any particular expiration date, there are going to be several choices in strike prices. And they're going to be aligned from whatever the current price of the stock is, going up numerically and going down numerically from wherever the current price of the stock is. Strike prices are set by the exchanges because they're the ones that are listing those option contracts. Now, there are two types of options. There are calls and there are puts. Here's the way that I remember this. Actually, two ways that I remember this. One is if I have the right to buy something, that's what buying a call option gives me, is the right to buy shares of stock. I'm calling those shares in from somebody else. If I buy a put option, I'm buying the right to sell those shares to somebody else. And so I'm buying the right to put them to that other party or the seller of that contract. So when I buy a call, I have the right to buy the stock. When I buy a put, I have the right to sell the stock. So the other way that I think about this is call options become more expensive when the price of the stock goes up. Put options become more expensive when the price of the underlying stock goes down. Because if I have the right to buy the stock at a particular price and the price of the stock goes up, that right becomes more valuable. If I have a right to sell the stock at a particular price and the price of the underlying stock goes down, that right to sell the stock becomes more valuable. So the way that I think about it is the old-fashioned telephone. Call up. When I went to make a call, I picked up the phone, call up, put down. When I was done with the call, I put the phone down. So call up, calls get more expensive when the price of the stock goes up. Put down, puts get more expensive when the price of the stock goes down. That's the way that I just kind of keep that relationship in mind here. So let's just kind of quickly summarize this. An option contract is either a call or a put. If we're the buyer of a call option, we're long that option, we have the right to buy the stock, the shares. If we have sold that option, we have an obligation to sell the shares to somebody else. If we're buying a put option, we have the right to sell the shares to somebody else. If we are short a put option, we have an obligation to buy the shares. Now, the way that an option contract is priced is really twofold. There are a lot of other influences here, but the two things that we need to pay attention to in an option premium, or what we pay for the option, is the amount of intrinsic value and the amount of time value. And time value is going to be determined by the length of time to go until expiration and how in demand or not in demand those option contracts are. But intrinsic value is very simply the mathematical difference between the strike price and the current price of the stock. So let's say, for instance, I've got a call option, which gives me the right to buy the shares of a stock. Stock's trading $100 a share. I have the right to buy the stock at $90 a share. That's my strike price. That option contract intrinsically is worth $10 a share because I could buy the stock at 90, turn around and sell it on the market at 100. Plus, it's going to have some time value. Now, likewise, if I had bought a put option, the price of the stock is trading on the market at 90, and I have the right to sell the stock to somebody else at $100, that option contract also has $10 of intrinsic value because I have the right to sell the stock to somebody else at a price that is currently higher than the trading price of the stock. So that is intrinsic value. So that's something that we're going to explore here in just a second. So I want to keep this in mind, but this is a good summary page for option basics, calls and puts, buyers and sellers, long and short, rights and obligations. Now, let's pop to the next one here. There's two main components, right? Intrinsic value, time value equals our option price. Intrinsic value is an option's inherent value without reference to its market value. Market value is going to be determined also by time value, the amount of time there is, the supply and demand, but intrinsic is simply that mathematical relationship between stock price and strike price. I'm going to say that one more time because it is that important. Intrinsic value is simply the mathematical difference between strike price and stock price. And the only thing that changes intrinsic value is the movement of the underlying stock. Only thing that changes intrinsic value is the movement of the underlying stock. The passage of time doesn't change it. Changes in supply and demand don't change intrinsic value. It is simply that difference. Now, here's the thing. At expiration, an option contract is going to be worth one of two values. It's either going to be worth intrinsic value or nothing. Intrinsic value or nothing. If there is no intrinsic value at expiration, all of the time value has gone away, that option contract is going to be worthless. If at expiration, the price of that stock makes that option contract intrinsically valuable, but all of the time value has gone away, that option contract is going to be worth simply intrinsic value. So all options contracts resolve to one of two prices, either zero or intrinsic at expiration. Good thing to keep in mind. So how do we determine intrinsic value? If it's a call option, if the price of the stock is above the strike price, we're going to call that in the money. That has intrinsic value. If the price of the stock is exactly the same as the strike price, we're going to call that at the money. That's not going to have any intrinsic value. It might, we still refer to at the money kind of being the closest mathematically. So an at the money strike might have a little bit of intrinsic value, might have no intrinsic value. It's simply a placeholder for showing where that price of that option is. Now, if a call option, currently the trading price of the stock is below the strike price, that option is out of the money, has no intrinsic value, and if it were to stay there through expiration, that option contract is now going to expire worthless. So call options have intrinsic value if the underlying price is greater than the strike price. For put options, a stock price that is above the strike price means that option contract is out of the money and it has no intrinsic value. Same as the strike price, that's going to be at the money, no intrinsic value. But if the price of the stock is trading below the strike price, that option is going to be considered to be in the money because it has intrinsic value. I could sell the stock to somebody for $100. That's my strike price. Stock's currently trading on the market at 90, $10 of intrinsic value. Puts have intrinsic value if the underlying stock price is below the strike price. Again, a good reminder of that. Now, there's some shortcuts that we can use to see in the money, at the money, and out of the money contracts. We'll see what that looks like here in just a minute. But there's that intrinsic value summary. Calls are in the money if they're above the strike. Puts are in the money if they are below the strike. That's just a quick reference page so that you can see what that moneyness looks like. So now, again, option pricing, intrinsic value plus time value. Let's talk about that time value component for just a second. Time value is the difference between an option's intrinsic value and what it's currently trading at, what the option is currently trading at on the market. So if an option contract has $10 of intrinsic value, let's say we have the right to buy the stock at 90, stock's currently trading on the market at $100. That contract has $10 of intrinsic value, but the premium that we would pay, or the option price, might be $15. So that contract might have $10 of intrinsic value and $5 of extrinsic value. So Ricebird asks a great question. Who sets the strike price? Who creates those strike prices on the option chain? That is set by the options exchanges. And they have some rules in terms of the magnitude of the price of the underlying stock and how big the increments are between the strike prices. But generally, one thing to think about is if there is more demand for options, options exchanges are going to be very reflective of that demand. And so they're going to list more options contracts. One of the ways in which they can list more options contracts is to list more strike prices. So you might have $5 wide increments, dollar wide increments, $2.50 wide increments, $10 wide increments between strike prices. In some cases, you might even have 50-cent increments between strike prices. So that's a good thing to think about. Now, Charles asks a question. What's the time component in this time value? So one of the things to think about is time, we know, is always passing forward. It's always slipping into the future. So time is a precious commodity, and time is not inexpensive. Time has value. So we think about that intrinsic value. That's simply a mathematical relationship. But time value is reflective of two primary things. One is One is the length of time to go until expiration. So if an option contract has a long distance to go until expiration, time-wise, there's going to be more time for the price of the stock to go up or down. Therefore, it's more valuable. So there's going to be more time value. If there is a short period of time to go between where you initiate the trade and expiration, there's not going to be as much time value because there's not as much time for the price of the stock to move up or down. It becomes less valuable. At the same time, the option contract becomes more sensitive generally to that passage of time. Even though there's less time available, each increment of that time becomes more valuable in the remaining time between now and expiration. So the sensitivity of the option contract to the passage of time increases generally the closer we get to expiration. We'll talk a little bit about that here in just a moment. So those are the two components, intrinsic value and time value. At the end of the lifespan of an option contract, time value, if we're at the end of its lifespan, all that time value is gone. So at expiration, intrinsic value is going to be the option price, or it's going to be zero if there is no intrinsic value. That is it. That is it. So a couple of things, and we'll answer a couple of these questions along the way as we get into this discussion too. Alexander asks the question, can an option be exercised? If I'm the buyer of an option contract, can I choose to exercise my right to buy the stock or sell the stock at any time up until expiration? And the answer is yes. If it's an American style option, you can choose to exercise your right at any particular time. Now, what does that mean if we're on the other side? Well, if I'm on the other side, if I were the seller of the option contract, there is the potential that I could be obligated or have to be assigned the obligation to meet that obligation. So if I had sold a call option contract and I get an assignment notice because somebody on the other side chose to exercise their right, I have to deliver shares of the stock. Or if I were short a put option and I get an assignment notice, then I have to buy or take possession of shares of stock. So that's how that relationship works, Alexander, between being the buyer of an option contract and the seller of an option contract. Buyers have rights, sellers have obligations. Rights can be chosen to be exercised at any point. Obligations, we can't choose. We don't have a choice to meet that obligation or not, but we wait for an assignment notice to tell us whether or not we have to meet that obligation. So those are some of the considerations there. Now let's pop back here to the next one. There's that time decay, right? So time decay loses value as we get closer to expiration. It accelerates as we approach expiration. We'll talk a little bit deeper about this when we get into option Greeks in one of the next webcasts. But this generally gives us an idea of the rate of that time decay as we get closer to expiration. Now, works always against us as the buyer of an option. Time decay is always working against us as the buyer of an option. Time decay is always working for us as the seller of an option. The rate at which it's working against us or for us is dependent on a number of things. One, how far out we are in time, how close we are to the current trading price of the underlying stock. So those are going to be some of the things that will determine our time decay sensitivity, which is sometimes referred to as theta. The option Greek theta is the mathematical variable that we use to express the sensitivity of an option premium to that passage of time. So let's do this. Let's pop back over here really quickly. I want to do one more slide here, and that is this. At that decision point for making a trade, there are things that we can do. We can choose to buy the option contract and then turn around and sell that option contract back to somebody else. We can do that prior to expiration. We can do that at expiration if we let it expire or let the option contract go through till expiration, and that option contract has intrinsic value, then it's going to be automatically, in most cases, exercised for us. If we're the seller of an option, we can buy back that option contract at any time, eliminate the obligation. We could be potentially assigned If the buyer of that contract chooses, or the buyer of a contract chooses to exercise their right, then we could get that assignment notice, or we can hold on to that option contract through expiration. If it has intrinsic value, then in most cases, we're going to be automatically assigned. If it doesn't have any intrinsic value, we let it go through till expiration, it's going to theoretically expire worthless. So those are our choices: buyer's choices, seller's choices. Now, here's the thing. One of the things that beginning options traders oftentimes are amazed at is the idea that as an option trader, a trader can buy and sell option contracts pretty much at any point between now and the expiration of that contract. And in many cases, not most, because I don't know most cases, I haven't seen most circumstances, but in many cases, options traders choose to buy a contract and then sell that contract rather than exercising their right or taking that option contract all the way till expiration and having that option contract, that long option contract, result in a long stock position or a short stock position. So let's do this. Let's pop over to the Thinkorswim desktop software platform and let's take a look at an example. So here is a stock that's been trending up. It's pulled back a little bit. It's now giving us an opportunity, maybe a little bit of a reversal pattern here. So as an option trader, I might be speculating on price movement. So we're going to take that speculative scenario here first. So from a technical analysis perspective, I've got a nice little reversal pattern here. I might be looking for a balance, and so I might be looking at getting into the stock and trading that to the upside. So I could buy the stock. I'm going to pay $310 or $305 per share. So if I were to just buy this stock right now, let's go to the trade tab for American Express, and I were to click on the ask price and I were to buy 100 shares of the stock, that's going to cost me $30,576. Now, the way that I could potentially lose all of that $30,576 in this trade would be the price of the stock going to zero. Not very likely. But there's also no upside cap on how far up the price of that stock could go either. And buying the stock gives me potentially dividends if the company issues dividends, gives me potentially shareholder rights, and it doesn't have a finite expiration date. So we could buy, I'm going to do this. Let's go right here. Let's just put this in our long options group. I'm going to click on send. We're going to fire that order off. I now own 100 shares of American Express, but it cost me $30,000. But if my expectation is, and looking at this chart, that the price of the stock might go up, let's say where the price of the stock is currently trading at 305, and I expect the price of the stock maybe to go to $320, where this next level of resistance is right up here. So I could buy the stock. That's a fairly healthy investment into that trade, or I could buy an option. I could buy a call option that expects that the price of the stock is going to go up. So we're going to go back to the trade tab, and we're going to go to the option chain here for just a second. So I'm going to make this intrinsic and extrinsic value so you can see that relationship. But here's the option chain. Information about the underlying stock is right here. But in the option chain, I have really two pieces of important information that I need to pay attention to first. One is the expiration date of an option contract, and two is the number of days to go until expiration. That's kind of the duration decision here. So let's say I want to go out, maybe out to the 18 June timeframe, and I think the price of the stock is going to make that $15 move to the upside in the next 72 days. Maybe it's going to make it in less time. That's fine. But I'm going to buy a little bit more time than I think I might need, just so that the stock can do what I expect it to do. So I'm going to go out here to the 18 June expiration, and we're going to open up that option chain. Now we've got our strike prices right down the middle. Remember I said that the strike prices are arrayed up and down from where the current trading price of the stock is? Well, there's the current trading price of the stock, 305. So I don't have a 305 strike price, but I have a 310 and I have a 300. So 305 is going to fall right in the middle of those two. Now, mathematically, That would mean that our 310, because it's 305.77, our 310 is what we would refer to as the at the money strike. You can see over on the left-hand side where I have call options, and on the right-hand side where I have put options, I'm showing right now intrinsic and extrinsic value. So the 300 strike call option has $5.77 of intrinsic value. You can see that changing as the price of the underlying stock moves. It's also got a fair amount of extrinsic value. That's a lot of time to go between now and expiration, 72 days worth of time. So intrinsically, if I have the right to buy the stock at 300 and it's currently trading on the market at 305.97 or 98, I have $5.98 of intrinsic value. But I'm going to pay a lot more for that because of that extrinsic or that time value component. So that gives me the right to buy the stock at $300 a share. So I'm going to click on that ask price for the 300 strike price call option. Gives me the right to buy the stock at 300 if I so choose. And I'm going to pay for that $24.30 times 100 shares in a standard contract. So if I click on confirm and send, and I read through this contract and this order, now I'm not buying the underlying stock, I'm not buying 100 shares of it. I'm buying the right to buy 100 shares, and I'm paying $2,430 per contract for that. So now how could I lose all of that? Because that's my potential loss in this trade. I could let this option contract expire worthless. That would assume that the price of the stock doesn't move, or in fact moves down, and I have no more intrinsic value at expiration. Because remember, this option contract is going to resolve to one of two prices. It's either going to have intrinsic value or nothing at expiration. So I'm paying a lot less. That's that leverage that we talked about. But leverage doesn't necessarily help us alone. I mean, it cuts against us as well, because I could lose all $2,430 if the price of the stock does nothing. Now, there's this very seductive term here, infinite maximum gain. That infinite maximum gain comes from the idea that there's no finite upward limit on the price of the stock moving. The likelihood of American Express going to infinity between now and the 18th of June is probably pretty unlikely. But could it? Potentially, I suppose. Theoretically, yeah, that's an interesting theoretical exercise. But we're going to go ahead and we're going to buy this option contract. We're going to click on send and fire that order off. Now we own 100 shares of the stock, but at the same time, we just bought an option contract that gives us the right to buy the stock at 300. Now, if the price of the stock goes up, great. If the price of the stock goes down, not so great. If the price of the stock does nothing, we lose all of that that extrinsic value. So if the price of the stock did nothing else from now on until we got to expiration on the 18th of June, we would still have $5.78 of intrinsic value remaining, but we would have lost all $18.34 of extrinsic value because of the passage of time and the fact that that option contract resolves to zero or intrinsic at expiration. So this is a wasting asset. We got to see the price of the stock move. We've got to move quickly, and it's got to move big in order for us to make money on the trade, because we're paying $24 on this stuff for this option contract per share. So we've got a break-even price. Remember, as we go back to that confirm and send, we see what that break-even price is. The price of the stock now has to move to $324.25 in order for us to break even on the trade. Because we're paying $24 for this option contract per share. So we got to see big movement. If it doesn't make that move, remember, we were looking for the price of the stock to go to 320. So maybe that's not the right contract to choose in this particular case. Something we need to think about in terms of selecting an option contract, which we will talk more about in further classes. But that's buying a call option. Let's take a look at another example here. Let's go to this one right here. Let's go back to our chart. Let's go to Disney. And Disney is in a bit of a downward trend, seems to be bouncing down from a resistance level, maybe making that move to the downside. So we're going to look at putting together a put option contract for Disney. We're going to go to the trade tab. Again, information about the underlying stock, expiration dates, time to go until expiration. So let's go out to that 18 June expiration now for Disney. We're going to open up that option chain. Now we're going to be over here on the right-hand side. We've got intrinsic and extrinsic value. So the stock's currently trading at $95.61, which means that a $95 strike price has no intrinsic value. It's out of the money. All of these ones that are shaded in purple have intrinsic value, thus are referred to as in the money options. Now, remember what a put option gives us the right to do. It gives us the right to sell the stock to somebody else at a particular price. So we want the price of the stock to go down in this case. This is how an option trader can speculate on downward price movement. So if I were going to buy an option contract here, I might want to buy the right to sell the stock to somebody else at $100 a share, even though the stock is trading on the market at $95.63, because I might have an expectation that the price of the stock might go down even further. That option contract has $4.35 of intrinsic value, $3.20 of extrinsic value. So we're going to left click on that ask price. And we're going to see that that references 100 shares of the underlying stock. We're going to click on confirm and send. Our cost in this trade, $7.65 times 100 shares, or in other words, $765. Maximum profit is no longer infinite maximum gain because the price of the stock can only go as low as 0. Now, the likelihood of Disney going to 0 by June 18th is probably marginally less than the likelihood of American Express going to infinity by June 18th. Same kind of thing, right? That's kind of that undefined potential. So we're going to put this one in our long option group. We're going to click on send. We're going to fire that order off. Now we own a long put option that gives us the right to sell Disney to somebody else. Now, the thing is, we go back to the monitor tab and we look at those two particular contracts. Here's the American Express contract. If the price of the underlying stock goes up, that option contract is going to become more valuable, and we could sell that contract to somebody else at a later date for more than we paid for it to begin with, theoretically. If Disney goes down, that option contract that we paid $7.45 for is going to become more expensive. We can turn around and we can sell that option contract back to somebody else at a later date, hopefully for more than we paid for it. If the price of the stock goes down, that's generally going to be, for most retail options traders, the path of managing the trade, looking to close the trade down when it has become more valuable by selling it to somebody else, not exercising our right and converting it into a long stock position or a short stock position, and not holding it through until expiration. All of those things we're going to talk more about as we get into later sessions. So a couple of things as we kind of wrap this discussion up and we get into this scenario. Let me pop back over here really quick. I want to take you to some resources. If you want to learn a little bit more about options in general and primarily about trading options here at Charles Schwab, this is a very easy reminder, schwab.com/options. And this gives you our options landing page. So what are option contracts? Why Schwab for options? How to get started trading options if you don't have options trading authorization already. What are options contracts? What are options Greeks? Some option strategies, how to trade them. Why trade options at Charles Schwab? So this gives you some great resources. Now, the next place is right here on the Trader Talks webcast page, which you're already familiar with, theoretically. If this is your first time here, or if you've not done this yet, click on that subscribe button. That's going to help you to keep this information at the top of your YouTube feed. It also makes it easier to find, but I'm going to type this in right here. Getting started with options. And when you type that in, now you're going to go to that playlist, the Getting Started with Options playlist. and you're going to see all of those webcasts where we talk about getting started with options. If you've got a specific question about options Greeks, you can go to those as well. You can type that in. But this gives you that resource that you can use to continue this education and continue to learn. And then if you go to schwab.com/coaching, this is going to take you to your live webcasts calendar. So you're going to see what webcasts are coming up. We teach a webcast on trading long options every Wednesday. I teach one on trading index options on Wednesday afternoons. We also teach a variety of different, more advanced option strategies topics. And for those of you that have not been to a live in-person event, we've got an advanced option strategies workshop coming up this weekend in Dallas. Following that, next week, we're going to be in Boston teaching a technical analysis and option strategies workshop. Day 2 is all about options, taking you really through these 12 steps from start to finish over the course of one day. It's pretty intense. We'd love to have you with us. If you're in that area, this is at no cost to you. Click on Learn More. That's how you can register for that event. We would love to have you be there with us. We're also then going to be teaching that in San Diego in June, and in Chicago in July, and in Orlando in August. We're going to be all over the country. So I'd love to see you at any of those live events. We appreciate you being there with us for those and joining us for those resources. Again, so what we've done so far, we talked about what to look at, how option contracts are specified, how they're created, options basics, the importance of understanding price and time. We placed a couple of different example options trades along the way, giving you some resources. Alexander asks one great question, and I'll finish up with this. If I'm long an option and it ends up in the money at expiration, if I hold it through expiration, does it exercise automatically? In most cases, yes, you don't have to do anything. That's automatically exercised. But one thing to think about, the way to realize perhaps more value in that option contract would be to sell that option contract to somebody else at a later date for more money than you paid for it to begin with. Guys, thanks very much for jumping in here with us today and getting started trading options. My thanks to Mike Fairborn for helping out, and to our great production staff and our great reviewers. Have a interesting day today, because the market is an interesting place for sure, and we'll see you back here again. Take care, everybody. Bye-bye.